In 1637, a single tulip bulb sold for more than a luxury home in Amsterdam. Not a rare gem, not gold, not land. A flower bulb, the kind that rots if you leave it on a shelf too long. Businessmen mortgaged their houses to buy flowers they'd never even seen. Sailors were thrown in prison for accidentally eating bulbs they mistook for onions. Then, in the span of 1 week in February, the entire market collapsed. Fortunes built over years were gone before the month ended. It was the first financial bubble in recorded history. And here's the part that should make you uncomfortable. The pattern hasn't changed once. This is Money Origins, where we trace the history of financial disasters so you understand exactly how they happen and why they keep happening. No host, just the story. By the end of this, you won't just know what Tulip Mania was, you'll recognize it, the specific shape of it, the next time it shows up wearing a different name. And it will show up. The question this video leaves you with is one worth sitting with long after it ends. If everyone in 1637 thought they were being rational, what does that say about us? Tulips didn't originate in the Netherlands. They came from the Ottoman Empire, cultivated in the gardens of sultans for over a century before a Flemish botanist named Carolus Clusius brought bulbs to Leiden in the 1590s and planted them at the university's botanical garden. What happened next was almost immediate. Dutch merchants, already the wealthiest trading class in the world, looked at these flowers and saw something they understood instinctively: a status object. Tulips bloomed in colors that no other flower in Europe could produce: deep purples, crimson flames on white petals. The rarest variety, the Semper Augustus, had a red and white streak that looked almost painted. Collectors would pay almost anything to have one in their garden. By the 1620s, tulip ownership had become a way of announcing yourself. If you had a canal house in Amsterdam, you had tulips. And if you had the right tulips, the broken varieties, the ones streaked and flamed by what we now know was a mosaic virus, you had something that couldn't be replicated on demand. That scarcity was the first ingredient. But scarcity alone doesn't build a bubble. Something else had to happen. Here's where it gets interesting, and where Tulip Mania stops being just a flower story and becomes the blueprint for every speculative market that followed. Because tulip bulbs can only be dug up in summer, buyers and sellers started writing contracts. You'd agree today to purchase a bulb at a fixed price when it was harvested months later. This was, functionally, the first recorded futures market in history. And like every futures market since, it meant people were trading things that didn't exist yet. By 1636, these contracts were changing hands in taverns across Dutch cities: Haarlem, Amsterdam, Delft. The bulbs themselves were still in the ground. Prices were doubling, then doubling again. At the peak of Tulip Mania, a single Semper Augustus bulb was documented at 10,000 guilders. A skilled craftsman at the time earned roughly 300 guilders per year. That one bulb cost the equivalent of a grand canal-side mansion in Amsterdam. Worth saying up front, the exact figures from this period are debated by economic historians. Some argue the scale of the mania has been exaggerated in popular retellings. What isn't debated? Prices rose dramatically, contracts proliferated wildly, and the crash was real. The pattern is real. New buyers poured in: weavers, carpenters, farmers. People with no background in trading started buying contracts because they'd watched their neighbors make money and couldn't see a reason to stay out. This is the phase every speculative bubble shares. The moment the asset stops mattering and the trade itself becomes the point. Nobody was buying tulips to plant them anymore. They were buying them to sell them to the next person at a higher price. The crash didn't arrive with a warning. It didn't build slowly. It came on a Tuesday. In early February 1637, a routine auction in Haarlem failed. Sellers listed bulbs at prices that had been standard the week before, and nobody bid. Not at full price, not at half price. The room sat quiet. Word moved fast. Within days, sellers across the Netherlands were trying to exit their positions simultaneously. But a futures market only works when buyers believe prices will keep rising. The moment that belief broke, there were no buyers, only an avalanche of sellers and contracts that were now worth a fraction of what people had paid. Within a week, the tulip market had effectively ceased to function. Bulbs that had sold for thousands of guilders were being offered for a few. Contracts couldn't be enforced because the counterparties had nothing to pay with. Courts eventually ruled that many of these contracts were essentially gambling debts, unenforceable by law. The people who had mortgaged real assets, houses, businesses, savings, to buy paper contracts on flowers, discovered that paper was all they had left. This is the part that tends to make people uncomfortable. Most of the buyers weren't fools. They were watching a market that had delivered real returns for real people. The logic felt sound, right up until the week it didn't. Here's what makes Tulip Mania worth studying, not just as a historical curiosity, but as a diagnostic tool. Every documented speculative bubble since 1637 has followed the same four-stage structure. An asset gains genuine value from real scarcity or utility. Early buyers profit visibly. Late buyers flood in chasing those returns, driving prices beyond any rational connection to the underlying value. Then, one failed transaction, one missed payment, one moment of collective doubt, and the whole structure inverts in days. .com stocks in 2000. Subprime mortgage securities in 2008. Meme coins in 2021. The assets are different. The story used to justify the prices is always new. But the architecture is identical to a tulip auction in a Haarlem tavern in 1636. The counterargument worth acknowledging. Some of those bubbles produced lasting infrastructure. The internet survived the dot-com crash. Housing, however distorted, reflects real demand. Tulips were genuinely beautiful. Bubbles aren't always irrational at their core. They become irrational at their edges, when the price detaches from everything except the expectation of a higher price tomorrow. That edge is the only place that matters when the selling starts. There's a house still standing on the Herengracht, Amsterdam's grandest canal street. Built in the 1620s, it would have been the kind of property a wealthy merchant could have traded for a single Semper Augustus bulb at the peak of 1637. The house is still there. The tulip market is not. What Tulip Mania actually gave us wasn't a lesson about flowers. It gave us the first documented proof that a market can detach completely from reality. Not because the people in it are stupid, but because belief is contagious, and momentum feels like logic when you're inside it. That question from the beginning is still open. If the Dutch merchants of 1637 genuinely believed they were being rational, what are we doing right now that will look exactly like this in 400 years? Worth sitting with. A quick note to close. Nothing in this video is financial advice. This is history and analysis only. What you do with your own money is your decision. If this raised questions about how these collapses actually unfold, who starts them, who profits, and who gets left holding the contracts, the next video goes deeper into exactly that. It's about the South Sea Bubble, a scheme so convincing it caught Isaac Newton twice. He lost the equivalent of millions. The story is worth knowing. It's up next.